Welcome to the Deep Dive. Today we are plunging into the details of a massive global business, getting our information straight from a key source you shared with us. A recent Form 10K annual report excerpt for the Coca Cola Company. Our mission here is really to cut through the jargon and pull out the most important insights. We'll look at how they're structured, their financial performance 2024 versus 2023, what's driving things, and, their plans for the future and for shareholder value. Think of this as your personal shortcut to understanding what's really going on inside this company based on the document itself.
That's right. And these 10Ks, they're just packed with detail, but they can be pretty dense to get through. Our goal is to help you navigate this specific report, connect the dots, and really understand the significance, not just the numbers, but what they mean for the business. Let's dig in.
Okay, let's start by getting a handle on the business structure. The report describes them as a total beverage company. And you really see that in the portfolio, right? Owning or licensing tons of brands. Trademark Coke, sparkling flavors, water, sports, coffee, tea, juice, dairy, plant-based, even emerging stuff. It's huge.
It really is. And what's fascinating is the core operational engine underneath all that. They basically run on two main lines of business: concentrate operations and finished product operations.
Okay, what's the difference there?
Well, concentrate operations, think of that as selling the secret sauce, the beverage bases, the syrups, to their bottling partners globally. Those partners then add the water, sweetener, package it, and handle all the local distribution and sales.
Got it. So the company provides the core stuff.
Exactly. Then you have finished product operations.
Right.
That's where the company itself is actually manufacturing and selling the final drink directly to retailers or consumers. And the report makes a really key point here. Concentrate operations generally have higher gross margins.
That makes sense. Less capital tied up in bottling plants and trucks, more focus on the brand and the formula itself.
Precisely. Now, on top of that operational split, they organize it into segments for reporting. You've got the geographic ones: Europe, Middle East and Africa, Latin America, North America, Asia Pacific, pretty standard. Then there's global ventures. This is kind of a mix. Includes businesses like Costa Coffee, Innocent, Dozadon, plus those distribution fees they collect from Monster.
Right. And the last one?
Bottling investments. That covers the bottling operations the company actually owns and consolidates into its own financial results.
Okay, so linking this back, that relationship with the independent bottling partners sounds absolutely critical. The report says most products are handled by them globally.
Foundational is the right word. The company provides the brand, the concentrate, marketing support. The bottlers do the heavy lifting of production and getting it onto shelves. And this ties into their strategy, especially in, say, underperforming markets. The report mentions they sometimes step in, acquire a local bottling operation to sort of fix it up, improve performance,
Okay.
and then often they'll divest it again later, sell it back to an independent partner. They call this refranchising.
Refranchising. So they get it running well and then hand it off again.
Yeah, often retaining an equity stake. So they still benefit from the upside without the day-to-day operational burden. It lets them focus back on that higher margin concentrate business.
That sounds strategic, but how does this whole system affect how they measure volume? It seems like there are a few layers.
It is complex.
Yeah.
And the report clarifies it. They track volume two main ways: unit cases and concentrate sales.
Unit cases, that's like consumer purchases.
Essentially, yeah.
Yeah.
It's an estimate of finished product sold by the whole system, bottlers included to the end consumer. It reflects consumer demand. A unit case, by the way, is defined as 192 U.S. fluid ounces.
Okay. And concentrate sales.
That's what the company sells directly to the bottlers, the syrups and bases.
And these don't always match up perfectly.
Exactly. Because of things like bottler inventory levels changing, seasonality, maybe a shift in the mix of products being sold, they can diverge in the short term.
Okay, got it. So looking at the 2024 numbers in the report, what did unit case volume look like?
Worldwide unit cases were 33.7 billion. That was up slightly from 33.3 billion in 2023. So some modest growth there.
And how does that break down?
Sparkling soft drinks are still the giant 69% of total volume. And trademark Coca Cola itself makes up 37% of the global total. Still the core.
Wow, almost half, and geographically.
Very important split. The U.S. is 16% of worldwide volume, meaning 84% is outside the U.S.
84%.
Yeah. And they specifically call out Mexico, China, Brazil, and India as the largest non-U.S. markets. Together, those four account for a third, 33% of total worldwide volume. Shows where a lot of the scale is.
That's significant concentration. And did all regions grow?
Not uniformly. The segment data shows Latin America, for example, up 3% overall in volume for 2024. But within that, Brazil grew a strong 8%, Mexico was up 2%, but Argentina was down a pretty steep 12%.
Wow, big difference. What about North America?
North America was flat overall in volume, even volume. But again, mixed results by category. Juice, dairy, plant-based were up 3%. Trademark Coke and sparkling flavors each up 1%. But water, sports, coffee, tea were down 4%.
So it really highlights how varied the market conditions and maybe consumer trends are across regions and even drink types.
Absolutely. They're navigating a lot of different dynamics globally.
Okay, let's pivot to the money side now. Unpacking the financial performance for 2024 versus 2023 from the income statement. Net operating revenues were up.
Yes, they increased. Went from about $45.8 billion in 2023 to $47.1 billion in 2024. Cost of goods sold was pretty flat,
Which means gross profit should be up too.
and it was, up from $27.2 billion to $28.7 billion. A nice increase in gross profit.
But why did revenue go up? Was it just that small volume increase?
This is where it gets really interesting, and it's a core insight from the report. Volume growth was only part of the story. The report explicitly says that price, product, and geographic mix had an 11% favorable impact on consolidated net operating revenues.
11% just from price and mix. That's huge compared to the volume growth.
It is. It means increasing prices, maybe selling more premium products, or having stronger sales in higher-priced countries contributed much more to the revenue growth than just selling more units. They even give examples like inflationary pricing they had to implement in places like Turkey, Zimbabwe, and Argentina.
Okay, so revenue and gross profit look pretty good, driven heavily by pricing. But then operating income, that actually went down, didn't it? From $11.3 billion to about $10 billion.
It did. Despite the higher gross profit, operating income decreased. And the report points to one really big reason.
Which is?
A massive jump in something called other operating charges. These charges more than doubled, went from $1.95 billion in 2023 up to $4.16 billion in 2024.
Over $4 billion. What are those charges?
Well, the excerpt we have doesn't fully break them down, but
Yeah.
whatever they are, their sheer size wiped out that gross profit gain and then drove operating income lower. It's a really key factor impacting profitability in 2024.
Okay, something to keep an eye on. What about below operating income, interest?
Interest income was up a bit, maybe from higher cash balances or rates. Interest expense also went up, which the report links mainly to higher average long-term debt levels. That makes sense.
And there was another line item, other income lost net, that had a big change.
A huge positive swing, yeah. It went from about $570 million income in 2023 to nearly $2 billion income in 2024.
$2 billion. Where did that come from?
This ties directly back to those strategic actions we talked about earlier, the refranchising and divestitures. The report details several large gains in 2024. $595 million from refranchising bottling in the Philippines, $506 million from selling an equity stake in Thailand, $338 million selling part of their Coke consolidated interest, $303 million from refranchising in India.
Wow, so those strategic sales of bottling assets or stakes really propped up the net income number, offsetting that drop in operating income.
To a large extent, yes. It shows how portfolio management impacts the bottom line, though that same line item also included things like foreign currency losses and costs related to accounts receivable programs, so a mix of things in there.
So putting it all together, consolidated net income ended up
Pretty flat, actually slightly down, $10.65 billion in 2024 compared to $10.70 billion in 2023. Net income attributable to share owners was also just slightly down.
okay. And taxes played a role here too, you mentioned.
Yes, the effective tax rate helps. The report notes they benefit from having operations in lower tax countries and from specific tax incentives, like in Brazil, Costa Rica, Singapore, Eswatini. There was a $346 million favorable impact in 2024 alone.
But there's a big but here, isn't there? The IRS issue.
A very big but. This is highlighted as a major risk. There's ongoing IRS tax litigation about transfer pricing for the years 2007-2009. The company already paid $6 billion plus interest in September 2024 related to this, although they're appealing it.
$6 billion paid, but that's not the end of it.
Potentially not. The report states the potential remaining incremental tax and interest liability for the subsequent years, 2010 through 2024, could be around $12 billion as of the end of 2024 if they ultimately don't win the litigation.
$12 billion. That's a massive potential hit.
It's a very significant number noted right there as a risk. Plus, they mention impacts coming from global minimum tax rules, OECD Pillar 2, starting around 2024 or 2025. So tax is a complex and potentially costly area for them.
Definitely something to watch. Okay, quickly on the balance sheet then. As of end of 2024, total assets.
Huge.
Yeah.
$100.5 billion, included about $10.8 billion in cash and equivalents.
And the big asset categories reflect the business model, right?
Exactly. You see $18.1 billion in equity method investments, those stakes in bottlers, $13.3 billion in trademarks, the value of the brands, and $18.1 billion in goodwill from past acquisitions.
So a lot of value tied up in intangibles and partnerships.
Yes, and they test that goodwill for impairment regularly. On the other side, substantial liabilities, including long-term debt. They use debt, manage the interest rate risk with derivatives. The fair value of total long-term debt was about $38 billion at year-end.
Okay. And cash flows. Any quick highlights there?
Operating cash flow was down quite a bit in 2024, $6.8 billion versus $11.6 billion in 2023. The report links this mainly to changes in operating assets and liabilities.
But investing activities.
That swung positive, generated $2.5 billion in cash compared to using $3.3 billion the year before. Why? Primarily those big proceeds from selling off investments, $6 6 days Bs, and business investments, $3 5 Bs. Think refranchising deals again. That inflow outweighed money spent on buying investments and on CapEx.
The hex being?
Property, plant, and equipment spending. That was $2.1 billion in 2024, up slightly from $1.9 billion in 2023.
Okay. And financing activities used cash.
Yes, $6.9 billion used, mostly for debt payments, dividends, and buybacks, though slightly less cash used than in 2023.
All right. So with all that financial movement, the price mix driving revenue, the shit from operating charges, gains from sales, that looming tax risk. What does the report say about shareholder value? What are the priorities for using cash?
They lay it out quite clearly. The priorities are in order. First, invest wisely back into the business that CapEx. Second, and they emphasize this, continuing to grow the dividend payment.
Back to the dividend.
Third, enhance the portfolio through M&A buying brands or businesses. And fourth, use excess cash to repurchase shares over time.
And did the numbers back that up in 2024? Dividends and buybacks.
They did. Dividends paid were $8.4 billion, which was up from $8.0 billion in 2023. So dividend growth delivered.
Okay.
Share buybacks, or purchases of stock for Treasury, were $1.8 billion. That was actually down from $2.3 billion in 2023.
Down a bit on buybacks, but they still expect to do them.
Yes, the report specifically says they expect to repurchase shares in 2025, primarily to offset dilution from employee stock plans.
So it shows a commitment to returning cash, definitely focused on that growing dividend, and using buybacks more opportunistically, perhaps.
Seems that way. The level can shift based on cash flow and other needs. Like M&A, they mentioned exploring things like the alcohol category and capital investments, which they project at $2.2 billion for 2025.
Okay, so looking forward then, based on this report, what are the main challenges and opportunities?
Well, the report lists a lot you'd expect. Intense competition pricing, ads, innovation, distribution, strong rivals, powerful retailers, new entrants, digital shifts.
Standard industry stuff.
Right. But also key risks like unfavorable economic or geopolitical conditions, inflation, recession fears, rising costs for materials and labor, attracting the right talent, especially tech and digital skills. Cybersecurity threat's a big one.
Yeah, ways.
Evolving privacy and data laws. Climate change impacts, think water scarcity or ingredient availability. Managing new product launches, like maybe alcohol. Maintaining those vital bottler relationships. And of course, the outcome of divestitures and that huge IRS tax issue we discussed.
That tax issue really looms large. How are they addressing these challenges?
The report mentions things like productivity initiatives, talent programs, cybersecurity investments, closely monitoring all the regulatory changes, privacy, tax, climate, and strategically evolving the portfolio, like we've seen with the refranchising and potential new categories.
So wrapping up the forward look, it sounds like they're navigating a pretty complex world.
Definitely. The core concentrate bottler system is key, but they're actively managing the portfolio, trying to adapt to consumer trends, investing in people and tech, all while facing some significant external headwinds. Economic uncertainty, regulatory changes, and especially that potential multi-billion-dollar tax liability are major factors to consider alongside their core operations and their plans to return cash to shareholders.
Wow, okay. That really was a packed deep dive, pulling all that straight from the 10K excerpt you provided. From unit cases and refranchising gains to those other operating charges, the tax litigation details, dividend priorities. It gives you a much clearer picture of this beverage giant's workings.
It certainly does. Seeing how the concentrate business, the bottlers, the different markets, and the big financial decisions, acquisitions, divestiture, shareholder returns all connect is really key to understanding the story this report tells.
So here's something to maybe chew on from this deep dive, directly from the report's implications. We saw that huge potential liability from the IRS tax litigation, right? And the report also mentioned increasing complexity around global tax and data privacy rules.
Significant risks highlighted.
How might those big non-operational risks ultimately pressure their stated capital allocation priorities? Specifically, their ability to keep growing that dividend reliably and buy back stock at the levels they might want to in the coming years. It's a key question hanging out there. Well, thanks again for bringing us these sources for this deep dive. We really enjoy helping you unpack the information that matters to you.